Hello, viewers, and welcome to this Investonomics webinar on the Union Budget 2023 with Pankaj Murarka, the founder and Chief Investment Officer of Renaissance Investment Managers Private Limited. In his over 2 decade journey as a wealth management expert, Mr. Murarka has won several accolades, including being named as one of the best fund managers by Outlook Money in 2014 and 15. So we're so glad to have you here. Good evening.
Good evening, Michalia. It's always a pleasure talking to you.
So till now, honestly, we've only heard people praise how fiscally prudent the budget was, how it's laid the foundation stone to a developing economy. Do you have a contrarian view, or would you like to pipe in on that?
Uh, all of us as analysts do wear our skeptical hat, when we analyze the budget. But I must confess, and this is honest confession, that this time around, I really, after scratching my head over the budget documents for over 2 hours, I couldn't find out a single negative that I could, highlight from the budget. So actually, it's after I said this yesterday that after a very long time, I'm seeing a budget to which I would give like a 10 out of 10 because it's just the right kind of budget, because it's a very fine balance between being ambitious to drive our growth, yet not being over ambitious, and yet being very pragmatic and realistic. And more importantly, the kind of budget maths that's baked in for the next year's projections is conservative and credible. And the budget recognizes the fact that we are in an environment where there's a lot of geopolitical turbulence globally, and 60% of world GDP is on the brink of recession. And in that context, India is an outlier economy. And the fact is that the whole world is looking upon to India to step up its role, India being now the fastest growing major economy in the world. So it acknowledges all of this, and it takes very calibrated policy measures to address each of these, and yet making sure that we're ambitious enough, to follow our growth pursuit. So, meaning the last time I think I gave a 10 out of 10 to a budget on my personal score was Mr. Chidambaram's dream budget, and that was 1998. So after 25 years, probably I think I have given a budget 10 out of 10.
And I think, if I'm not mistaken, that was about the start of when globalization actually happened in 1998.
Yeah, because that was the first budget of UPA 1, and really, it laid down new path for the economy, and we all coming out of Asian financial crisis, where there were too many headwinds. India was a small economy, and then it gave a new hope. It laid out a new, completely very ambitious path for the growth of the economy. There were tax rate cuts at the same time, and very ambitious growth plans. And what happens is when the finance minister gives that kind of budget, it inspires corporate India. It helps corporate India to revive the animal spirit. It gives confidence to business and to consumers that the government is there to take care of things, to drive growth and make things better. So which is why, apart from the budget mathematics and let's say policy initiatives, the language and the body language and the tone in which the government talks or speaks matters a lot, because this is one such speech or a document which I think almost every Indian at least tries to get a handle on in terms of understanding what the government is thinking and talking about. So in that sense, in that context, it becomes very important.
So from a stepping stone, from putting a footprint into the world map to actually now trying to lead on the world map, we've come a long way in the last 25 years. But we still saw, I think, one of the worst FII outflows in the last few months. What is your take on that? I mean, despite us being one of the strongest performers in the global economy, we still saw an FII outflow. Why do you think that is? And do you see a renewed interest now post this?
Sure. So one, I must say that I don't feel too worried or concerned about the FI outflows that we've seen in the month of December and January. I understand that we've seen outflows of something like close to, I think, about
1,000 crores.
yeah, $4.5 billion over the last 2 months, 8 weeks or 9 weeks. But I think that's partly to do with some year-end profit booking, because a lot of these foreign investors end the year in December or early January where they want to take money off the table. And so on. I think last couple of days volatility is because of issues around a particular group of stocks and all of that. But from a broader market perspective, I don't feel too concerned about the outflows. More importantly, I feel very excited because from my conversation with a lot of foreign investors, because we run an offshore fund as well, I believe that the moment probably towards sometime in March, April, hopefully the US Fed should go on a pause, because they've been doing very aggressive rate hikes over the last 15 months. And once that happens, I think there'll be a risk on globally, which effectively means global investors will start putting money back into emerging markets. And what I want to highlight really for the benefit of all the viewers is, please understand, at the time of COVID, when there was a risk on globally and money was flowing into emerging markets, India's weight into MSCI emerging markets was about 8.5%. Last 3 years, because Indian markets have done very well, and Chinese markets, on the contrary, have not done so well. Today, India's weight in emerging markets or MSCI emerging market index is 15%, which effectively means for the same amount of global flows, India will get 2x of the flows that we got during 2020-21, when FIs really started putting money into or investing in emerging markets, because emerging markets are considered to be riskier assets. And generally, the behavior of global investors is when the Fed is cutting rates, they invest money into emerging markets and vice versa. So this time around, I think the flows that India will get will be significantly higher than what we saw in the last cycle. Because the fact remains that India is the best game in the town. It's the most exciting and most compelling investment story globally. We are now the fastest growing major economies in the world. Our growth will be far higher than China over the next probably 15, 20 years. And everyone wants a piece of the pie. So I think despite my optimism, I am myself underestimating the potential foreign flows that will come into our markets.
So, like you said, the FIIs are all poised to come back very soon once they've consolidated their books. Do you think right now for domestic investors is a good time to pick up value stocks at this moment before there is a huge bounce again in the market when the FIIs come knocking?
Absolutely. I've been saying this and I continue to say this. Indian equities are in a bull market for the next 25 years. Every time markets fall, it's an opportunity for investors having a medium-term to long-term view to buy into high-quality growth company, because that's the time when there's capitulation, there's blood on the street. That's the time when you get to buy stocks at probably 10-20% cheaper than what they otherwise would have been. And I firmly believe not investing into Indian equities is a much bigger risk than investing into equities. Because if you invest into Indian equities, if there's a short-term correction, you can lose 10-15% or something like that. But if you don't invest into Indian equities, then there's no other comparable asset class which can give you returns which equities can generate over medium to long term. And secondly, you cannot afford not to invest into the most exciting and probably the highest return generating equity markets in the world. So I think it's a great time for investors to really go out and pick good quality growth companies and then stay invested in them from a medium term to long term horizon.
So what sectors would you recommend we look at?
I think we like private sector banks. So banks have been doing phenomenally well. There was a time pre-COVID when we had a huge NPA issues in the bank. I think all those issues are behind. We have done reforms in the banking sector. We have a bankruptcy code now, so probably will not have bulging of NPAs. There is a strong underlying growth in the economy, because of which credit growth is very strong. Banks are very well capitalized, and they've reported some very phenomenal financial results over the last 4-5 quarters, and I think that will continue. So India's banking sector is in a very fine shape, so that looks pretty exciting. Apart from that, we are positive on capital goods as a sector because after a long time, we're seeing revival of private sector capex in India after almost a gap of a decade. More importantly, the government continues to maintain its thrust on investments in capital expenditure, and this has been reiterated in yesterday's budget as well, where the government's capital expenditure outlay has gone up by 33% this year, and it's now almost 3x versus what it was pre-COVID. So that's a phenomenal thrust that the government is making. So I think given all of these, capital goods, engineering and capital goods sector will do very well because these companies are flush with orders, and the kind of ordering momentum they will see is going to be very strong. And apart from that, we also like consumer discretionary because we think at the end of the day, India consumption story is very robust. You travel across,
especially with the new tax. Yeah.
yeah,
With the new personal tax.
that leaves, you're absolutely right, Natal. Yeah. The new personal tax with the reduction, higher rebates and lower tax rate, it leaves more income in the hands of the consumers to spend, and it partly offsets the impact of inflation which these consumers have been otherwise facing. More importantly, meaning you travel across India and you realize, hotels you don't get hotel rooms, you don't get flight tickets because they're all fully blocked. Over the last 3 weeks, I've been out for 2 weddings in different parts of Bombay, and the kind of celebrations that I've seen are just crazy. I haven't seen in a very long time. The way consumers are spending, across consumer discretionary is really, and on top of that, we have a very strong job market wherein hiring is very strong across financial services, IT services. So all these people and there are a lot of these first-time engineers who are getting into IT services, and all these engineers who are starting their career at a salary of 6 lakhs, 8 lakh, probably a couple of years out, they're the ones who are going to buy their first mobile, first car, first house. And all of that is going to again feed into a very strong consumer demand. So I think India's consumption story remains very robust.
So with the emphasis on actually moving to a more digital world with, skilling labs in AI, robotics, IoT, and all of that the government has planned, do you think that would put a slight risk to labor jobs that are currently there?
Not really. I started my career as an IT analyst in '96. And the fear at that point of time was when Y2K happened, that now computers will eat into the jobs of all the people because computers will do all the jobs. But that did not happen. Yeah. So every time technology makes progress, we fear that technology will eat into our job. But that's never the case. What technology does is it aids us in terms of improving our efficiency and productivity, so that we're able to do more things, or as professionals or as workers or service providers, we're able to deliver more output and make ourselves more productive and more efficient. So I think we should adapt technology and not fear technology. So I don't think so. Probably technology will make all of us more efficient, and a lot of things that we're doing today, probably technology can take care of that. Then I'm sure all of us can reskill ourselves to doing better things and many more things.
So for the move to more of EV and non-fossilized fuel, do you think that's going to, by 2030, we're seeing the aim is to adopt green hydrogen in a big way, or non-fossilized fuel in a big way. How do you think that will impact the oil and gas sector?
Well, I'm a firm believer in clean energy and the energy transition that the world has and will have to undergo, because that's very essential for the planet Earth, right? Given we know the consequences of fossil fuels. Having said that, I still think that that transition is a slightly more long-run transition, because the dependence of the world on fossil fuel cannot be reduced overnight. So I think fossil fuels are here for the next 10 years at least. And we need them. We'll always need them, just that probably our dependence will start reducing on them. But I don't see a meaningful reduction in that dependence, at least in the next 5 to 7 years, because all of this energy transition requires a lot of investments. and it will be at least 5 to 10 years before they start yielding results. So I think we are in a world or environment where fossil fuels will remain essential part of our life, and at the same time, clean energy or clean sources of energy will start emerging, but will take a while before they become a meaningful share of our fuel consumption or energy consumption.
So, with the new tax regime coming in, I think with that announcement, at least yesterday, the insurance sector took quite a slide. How much do you think this movement, because we don't have to, ATC isn't so important anymore for a bigger chunk of people.
Sure.
How do you think this will impact the insurance business overall going forward?
Well, I don't think so. It will have a significant impact over a long period of time, because the finance minister has done a very finely balanced job here. So as long as the annual premium is up to 5 lakh rupees, there is no change for any citizen. It's only for that small section of citizens who've been investing more than 5 lakhs into annual insurance, where they'll end up paying taxes now, because they've been using insurance more as a saving product than a pure insurance system. That section or percentage of people or consumers investing more than 5 lakhs annually, paying annually more than 5 lakhs of premium, is very small or minuscule. So I don't think so that impacts the long-term growth of insurance companies and the insurance sector, because the fact remains that as a country we are still significantly underinsured, and we need insurance penetration to grow significantly in this country. So I don't see it'll have a meaningful impact.
That's all the questions we have for you. Thank you so much for joining us. I think our time is almost up. It's been a pleasure talking to you, sir. Anything else you want to leave our viewers with a short word of advice before you go?
Yeah, sure. My only advice, friends, to all of you all is Indian equities is the most exciting equity market in the world. You cannot afford not to invest in Indian equities. And as I always been saying for the last 25 years, that not investing into equities is a much bigger risk than investing into equities and having some short-term losses. So just believe in India's story, because India is a happening place in the world. The whole world is looking upon us, and I think Indian equity is the most exciting place to be in. So buy into Indian equities and stay invested in it for a long period of time. And on that note, thank you very much, Nitya.
Thank you so much, sir.
Yeah,
Pleasure talking.
thank you so much. Pleasure.